I am Kim Snyder, and thank you so much for joining me for the Sane Crypto Podcast, the first cryptocurrency podcast for baby boomers investing for retirement. This podcast is brought to you by the Sane Crypto Mastermind, which is my signature program for those who want the diversification benefits and return potential of cryptocurrency with the guiding hand of a 20-plus year investment professional who has a proven track record through both bull markets and bear. Now, because it feels like things are getting just a little bit dicey between the political uncertainty here and abroad, the losses in the stock market, and the 70 plus now, more than that, percent pullback in cryptocurrency, I created a brand new free guide for you called When Things Get Wild, How to Protect Your Portfolio and Still Get a Livable Return. You can find that at sanecrypto.com/bear market, all one word. So again, to get my free guide, When Things Get Wild, sanecrypto.com/bear market and hit the orange download now button. So depending on how much of a student of the market you are, you may or may not be aware that things are much different today than they were even 30 years ago. And you may think I'm talking about all the technological innovation that's taken place. And although true, that isn't what I'm referring to. In 1974, the U.S. Congress passed a law called the Employee Retirement Income Security Act, or ERISA for short. And on that day, the 401k plan was born. And thus began the inexorable slide away from defined benefit plans, or what are known as pension plans, where the employer bore the burden for providing retirement income for life, to defined contribution plans, like a 401k, where the employee now bore the responsibility for themselves. And suddenly, whether you knew it or not, whether you were prepared or not, you had to basically become a professional investor, which barely existed before that. And that's because your future standard of living for what could be up to 40 years now in retirement was almost wholly dependent on your portfolio management skills. Or if you didn't acquire those or have any of those, luck, which is not a great place to be. Prior to ERISA, the stock market was a pretty sleepy place. Your grandmother or grandfather may have owned a few stocks that they had socked away for a rainy day, but mostly they owned bonds. Why? Because up until that point, you were really just trying to earn enough that your savings didn't get eaten away by inflation. Today, you have to do a lot more than that. Most of us have to save and earn a low double-digit return on our savings over our lifetimes to have any hope of paying our taxes, our bills, and staying ahead of inflation. Specifically, the formula for required rate of return is the expected withdrawal rate in retirement plus the average rate of inflation divided by 1 minus your marginal tax rate. So if I assume a 5% withdrawal rate each year, which is not very much, by the way, 3% inflation rate, which is also not very much, and let's say 33% marginal tax rate, that gives me a required return of 12.5%. 12.5%. And if any of those assumptions are too low, that 12.5% number will have to go up. So the first problem you have is that you likely have a required rate of return of something like 12.5%, and over long periods of time, the stock market only returns 8 to 10. And a blended stock and bond portfolio returns even less. The second problem is that 8 to 10% from the stock market is too dependent on market cycles. It really didn't matter that the 10% average is made up of some up years and some down years when you didn't need to withdraw money every year. But now you do, and it does. This is known as the sequencing of withdrawals problem. Or sequencing of returns problem is the other thing it's known as. If the down years occur near the beginning of my retirement, the odds of my running out of money are enormously higher compared to if the down years happen in the later part of the sequence. Exact same average return over time, but depending on the sequence of returns that make up the average, very, very different result. And again, this is only an issue when you have to withdraw money. But nowadays, unless you work for the government or some other rare employer who offers a full pension, you will have to withdraw money. And the third problem is that chances are, because everybody is, you're behind. I mean, so first, if you were in the early cohorts of baby boomers, they just did a flat bait and switch on you. You were, you grew up, you worked for a long time being promised a lifetime paycheck as long as you stayed at your job and were a loyal employee. And then they switched the rules midstream. And maybe you were savvy enough to understand what was happening and take control. Maybe you weren't. Lots weren't. How could they be? So those people are in a bind. Then of course there is the financial crisis, which wiped out some $2.7 trillion in retirement accounts. And as I'm sure you know, now the market has returned well over its historical average in the 10 years since. But most people have fallen prey to the faulty wiring in our brains, which cause us to sell bottoms and buy tops over and over again. In fact, an article in CNBC that ran at the 10-year anniversary of the financial crisis noted that less than 10% of people surveyed were investing more than they had prior to the crisis, which we can take to mean that 90% are investing less, in spite of the fact that they are now farther behind and should be investing more to take advantage of, this high return period. But in fact, they're doing the opposite because of fear. So to me, this is what make cryptocurrencies specifically, but alternative assets more generally, of which cryptocurrency is just one, really, really compelling. I think what we are seeing and will continue to see is retail investors shimmying up the risk pole because they have no choice. Back in the day, right, a few savings bonds would probably do the trick. But as the high watermark of required return keeps rising, we've seen investors move to mostly bond with a little bit of stock, and then very little bond with lots of stock, to mostly stock, to then derivatives like options and futures. And the next leap, in my mind, has to be alternatives. It has to be. And at first, right, it will be a little bit of alternatives, should be a little bit of alternatives with a lot of stock, and maybe some options if you're comfortable with that. But over time, unless we somehow miraculously change to a nation that offers some sort of universal guaranteed livable income and healthcare benefits for life, which I don't see happening anytime soon, retail investors will have no choice but to slowly inch towards higher and higher allocations to alternatives in order to get that required rate of return. Because it's either that or starve. So the question is, what does that mean for you? I believe alternatives, including but certainly not limited to cryptocurrencies, are going to become as commonplace in the next few years as stocks and options are today. Not because of wishful thinking, but because they have to. And if you haven't gotten up to speed on this asset class yet, now's the time to get going. As always, food for thought. I hope it helps. And before we wrap up, I'll just mention again the free guide that I put together called When Things Get Wild, How to Protect Your Portfolio and Still Get a Livable Return. You can find it at sanecrypto.com/bear market, all one word. You can get the full show notes of this episode, including links and references at sanecrypto.com/podcast. And finally, as always, if you have a question about today's topic or anything else, just email me at askhim@sanecrypto.com. I read and answer every email personally, as well as answer a few of them here on the show. Everything I say on this show is for educational purposes only. Nothing should be considered investment advice. Past performance is no guarantee of future results. All investments involve risk, so do not, under any circumstances, invest money you can't afford to lose. That is it for me. I am Kim Snyder, and I'll be back next week. Until then, may the crypto gods smile on us all.